Good morning, everyone. My name is Cameron Gleeson. I'm Senior Investment Strategist from Betashares. We're delighted that so many of you could join us for today's discussion. Today, I'm going to be joined by some gentlemen from the Nasdaq. We're going to have what I think has been a really topical discussion. The topic of the Nasdaq and big tech has been a theme which has been something that people have really been wanting to talk about for the last year, understandably so. But we're going to look into these stocks within the Nasdaq, how they've managed to drive such strong performance, as well as talk about some new indices which are now newly available in Australia through two new funds that Betashares has just launched just over a month ago. Thank you very much for joining today's discussion. We hope that this will be a valuable conversation for you. Just briefly before we get stuck in, I should point out that myself, Betashares, and the gentleman from the Nasdaq are not your financial advisor. This should be considered general information only. Please seek your own personal financial advice. And we will also send you a recording of this webinar, as well as the attached slides, and perhaps an insightful paper from the Nasdaq we might include there too. So if you or any of your colleagues have missed it or would like to watch a rerun, you should receive that in your inboxes. Throughout today's discussion, you'll have the opportunity to post questions in the GoToWebinar widget. If you see there on the right-hand side of the screen, just type the question into the box and hit send. We have seen a large number of questions. I'd probably describe it as a deluge prior to this webinar, so we'll try to get through as many as them, as well as address some of the ones that come through live. If we don't get a chance, we'll try to get to your questions subsequent to this discussion. As always, we'd like to to just make you aware of the resources available through our website or our social links. We produce a lot of material, a lot of insights, and indeed you can see some pieces which are from the Nasdaq, guest writers, if you like, on our website, recently discussing some of the indices there. So sign up to our weekly newsletter. Look at our socials. There's plenty of information. You can also look at Bass Bites, our Chief Economist's weekly post. Who are Betashares? I'm sure many of you on this call will be well aware of us. We consider ourselves a leading ETF provider in Australia. We have the widest range of ETFs available on the ASX. And we also, we're quite proud of this fact. Over 1 million Australians have money invested in a Betashares fund. We take that duty very seriously. We know that this is a duty of care that it's really important for us to provide relevant investment exposures and deliver good outcomes to clients. Part of doing that is really our partnerships, who we work with and how we work with other participants. And a really strong partnership for us over the years has been our partnership with Nasdaq. They are an index provider that has not only great indices, but also a great research team and a really useful resource for us. So with that, I'll invite today's guests onto the chat. So we've got Mark Marex and we've got David Tsoi. They come to us from Nasdaq's Index Research and Development team. They're responsible for looking under the hood and doing a lot of research into the underlying constituents or stocks within the Nasdaq indices. They produce a lot of really great research in terms of those indices, as well as working on new index development. Mark joins us from New York, where I think it's sort of late in the evening there. So Mark, thank you very much for joining us. And we've got David's joining us from Hong Kong. So we've got a bit of a global feel to today's webinar. Mark previously worked in asset management. He was a co-founder for Roundtree, which is a US asset manager that we know well. Prior to that, worked in a bulge bracket Wall Street investment bank. And David has also got has got deep experience in ETFs throughout Asia and was responsible for the launch of over 20 ETFs in the Asian region. These guys really do understand the Nasdaq indices, the underlying companies in those indices, and they do a lot of work. So they really are the perfect guests to sort of take us through what is going on and how these indices have been so successful for such a long period of time. So a bit of an agenda. I'll hand over to Mark and David. They'll talk a little bit about if you like, the innovation, perspective that these companies take and how they're able to drive earnings growth and compounding earnings growth over time. We'll also have a chance to talk through these two newly available indices, the Next Gen 100 and the Equal Weight Index, and some of the characteristics of those indices and what might make them appealing as a complement or alternative to, for example, the Nasdaq 100. And finally, I'll touch on the investment implications and also the use cases for indeed NDQ, our existing large fund, as well as these two new funds. And we'll wrap up with some Q&A. Just before, again, I hand over to the guys, I just wanted to make one clarifying point. People in finance, they love acronyms, and we're no exceptions to that. We've got all our ASX ticker codes. And I just wanted to pull this slide up here just so there was no confusion. When the guys are talking, they'll typically refer in charts to the indexes by their codes, which you see across the top of your screen there. So for example, the Nasdaq 100, the index code is NDX, whereas the ticker code for our Nasdaq 100 ETF is NDQ. Probably the best way of sort of, distilling the difference there is if it's got an X in it, it's probably the index. If it's got a Q, it's going to be the ETF. But with that clarifying point out of the way, I'll hand over to Mark and David.
Thank you so much, Cameron. Real pleasure to be joining you and your audience today. Thank you, everyone, for sharing your time with us. It's my pleasure to kind of walk you through really the crown jewel of our index business, the Nasdaq 100. We consider it to be the benchmark of the 21st century. And the way we tell this story is that, what makes the Nasdaq 100 special at the end of the day really does come from the history of Nasdaq as a stock exchange. So Nasdaq was founded all the way back in 1971 as the world's first fully electronic stock market. That was also the year that Intel went public with an IPO on Nasdaq exchange and sort of kicked off not just the semiconductor industry globally, but also kicked off a trend of innovative, forward-thinking tech firms to IPO on Nasdaq over the coming 5 decades. So you see there Apple in 1980, Microsoft in 86. The Nasdaq 100 officially started being calculated in 1985. Then in the 90s, you had names like Cisco, Amazon, NVIDIA. In the 2000s, Google, now known as Alphabet, Tesla in 2010, Facebook, now known as Meta Platforms, 2012. And then sort of after that really impressive streak of winning many of the biggest tech IPOs, in 2014, we started as an exchange 39, about to be 40 consecutive quarters of IPO leadership in the US, beating out the share of IPOs versus the New York Stock Exchange, to get to a point now where at the end of last year, we had about 3,400 securities listed on the Nasdaq Stock Exchange, in total over $24 trillion of listed market cap, second largest exchange in the world, and pretty quickly gaining on NYSE. So that's sort of the exchange story. So what is the Nasdaq 100 then? You might be asking yourselves at the end of the day. People often talk about it as, oh, it's a tech index, oh, it's a growth index, it's this, it's that. It's kind of a lot of things. It doesn't fit into one particular bucket very neatly. The thing to really keep in mind is that it's Nasdaq listed companies only. That's the thing that's always going to be 100%. It's never going to change. And because it's Nasdaq listed only, and Nasdaq's only been around for about 50 years, most of your allocation is going to be to companies that haven't been around that long. There's companies listed on the NYSE that have been around for 200 years. In this index, in the Nasdaq 100, which is 100 of the largest non-financial companies listed on the exchange, around 86% of the weighting is companies that went public in 1980 or more recently. And we think that makes it really unique. It's also unique among US equity benchmarks in that it's the only major exchange-driven index with substantial AUM in the US ETF industry. The triple Qs managed by Invesco's, those are over 250 billion recently. There's tens of billions of additional AUM tracking in other ETFs. That's pretty unique in the US market, given the size of NYSE as the other big exchange. Tech exposure plus, right? People think of it as a tech-only index. It's really not. Depending on the sector classification system you use, we at Nasdaq use ICD. You have about a 58% allocation to tech as a sector. If you use GICS, the S&P classification, it's only about 50% allocated to IT. So it's not a pure tech index. You have other major sector allocations, things like consumer discretionary and healthcare, which we'll get into a little later. It's also growth exposure plus. So it's not pure growth. We don't pick companies based on their financial metrics and whether they meet some arbitrary definition of what makes a growth company. But we are usually going to be mostly weighted towards growth companies. So recently, we had about a 70% overlap with Nasdaq's own US large cap growth index. And then finally, it's US exposure plus. Nasdaq is a US exchange, but it attracts internationally based companies like AstraZeneca, like ASML, like Lululemon, even like Atlassian, right? The big Australian tech company, to do either a primary or a secondary listing on Nasdaq. And that's how you get a little bit of international exposure as well in this index. I want to start off this conversation by really taking a look back, really zoomed out basis on the long run performance record for the Nasdaq 100. We're up about 847% on a total return basis since year-end 2007. That is 2.5 times what you get with the S&P 500, the main large cap equity benchmark in the US, up there in the purple, 348%. It's also more than 1.5 times the return of the leading US large cap growth benchmarks, the S&P 500 growth in the blue there, and the Russell 1000 growth in the green. The closest that you'll get in terms of large kind of benchmark index returns in the US is looking at something like the S&P Tech Select Sector, which is a standalone information technology exposure. But again, keep in mind, we're only about 50 to 60% tech. So you get about twice the diversification, but the same returns as the leading sector index in the US. And you do it with only marginally higher volatility than the S&P 500. Over this time period, it's about 23% annualized vol versus 21% for the S&P. On a returns basis, it's about 15% annualized returns for the Nasdaq 100 versus about 10% for the S&P 500. So really, really favorable trade-off of performance versus volatility. What happened last year? Before we kind of kick off into where we are currently with the index, last year was a really unique year. I think the confluence of factors between tech earnings holding up much better than expected going into the year. There wasn't an earnings recession for the Nasdaq 100. That was the consensus going into 2023. Combined with the rise of generative AI as this new massive secular growth theme, this growth driver that people really didn't see coming into 2023. And on top of that, the regional banking crisis in the US, which maybe seems like ancient history now, but around a year ago was pretty scary and drove the return of the big tech sort of defensive trade in the US and globally, people recognizing again that if there is volatility in the equity market in a place like financials, there is a lot of safety to be found in a place like the Nasdaq 100. That trend really continued throughout the entire year, where you have this reinforcement from better than expected earnings, better than expected guidance, especially from the likes of NVIDIA, Microsoft, Meta, Google, and Amazon, sort of leading the charge throughout the year. And you have this really wide dispersion in index performance. We beat the S&P 500 by about 30 percentage points last year. We beat the Dow Jones by about 40 percentage points last year. We beat the leading banking and financial sector benchmarks in the US by almost 60 percentage points last year. So it really was another one of those years where tech and more broadly the Nasdaq 100 was in a leadership position through this sort of confluence of technical and fundamental factors. If you look at what happened to the index and its constituents over the course of 2023, some people have been wondering, have valuations gotten ahead of themselves? Are they a little bit too expensive versus what they should be? If you drill into the company level changes in valuation versus their performance versus their EPS growth last year, it's a really mixed story. So NVIDIA in the top right of this chart, their PE actually compressed by about 30% over the course of 2023, despite their price going up by 239%. That's because they grew their EPS by 380%. So really, really massive EPS growth for NVIDIA. Meta, not quite as much, but still really impressive and still a story of price performance was mostly driven by improving fundamentals, not valuations getting more expensive. Amazon got less expensive throughout the year. Another one. You'll see Tesla kind of sticks out like a sore thumb here in the bright red. That's the only one of the Magnificent Seven where price performance was not driven by fundamental improvement and earnings growth acceleration. earnings actually contracted over the course of the year with Tesla. So a very mixed story, but at the end of the year, you got to a point where, the median company in this index was up about 34%. The median company grew its earnings by about 15%. So approximately, 50-50 split, whether you look at this on an index weighted basis or on a company level basis, 50-50 split between kind of decomposing that performance into earnings growth as the driver versus simple multiple expansion and valuations getting a little bit more expensive, which you should expect, right, if there is an acceleration in the consensus for earnings growth looking out into next year and years beyond. I'll do a quick kind of run through of sort of what is the overarching fundamental story for this index over the last 10, 15, 20 years. And it's this notion of the new economy is taking over, we think, in the US and also increasingly globally. And it comes from three sectors. It's tech, which I'm sure everyone guessed I would mention at this point, but it's also things like consumer discretionary, consumer services, depending on how you define that, as well as healthcare. If you look at all the major sectors in the US over the last decade, what's the top line growth been? Real estate, I kind of shaded lightly there because it's only about 1% of the total. But the three leading sectors that make up a big chunk of the economy in the US that have grown the fastest are the same three sectors that make up the bulk of the index. So on a new economy basis, tech plus consumer discretionary plus healthcare, that's going to be 80 to 85% of your index weight, your index exposure, sort of no matter what. That's the thing to keep in mind. That's where the top line growth is really coming from. And so if you look at on an index weighted basis, Nasdaq 100 revenue growth over the last 2 decades, this century, about 10x versus just under 3x for the S&P 500. So more than tripling the top line growth of the S&P 500. If you look at bottom line earnings growth, Nasdaq 100 about 30 times increase over the last 2 decades versus just under 6 times for the S&P. So earnings are actually accelerating even faster for the Nasdaq 100, about 5 times faster than the S&P 500. Dividends, we were starting from a pretty low base, so pretty easy comps on that one, but very, very rapidly approaching the dividend yield of something like the S&P 500, given, a lot of those big tech names recently have announced dividend programs in addition to buybacks. So if you look at the valuations today, which are kind of in the low 30s range, and you plot that against the last couple of decades, you'll find that it is kind of towards the upper end of what the historical range has been. But interestingly enough, valuations are just about where they were 2 decades ago. Before we had social media, before we had smartphones, cloud computing, AI, any of that stuff that we increasingly recognize to be part of everyday life and everyday commerce. So you have to keep in mind, I think, the valuation question for today and looking forward. What does it represent versus the opportunities that were available to the companies in this index over the past 5, 10, 15, 20 years? Given where we are with the secular growth driver of AI arriving in force over the last year and a half, it doesn't seem outlandish to me to expect current PEs to be a little bit elevated versus what you've seen over the last 10 to 20 years. And you can look at this any way you want, whether it's PE, whether it's price to book, price to cash flow, EV over EBITDA, EV over sales. Going into 2023, we were trading at discounts, very cheap relative to history on the Nasdaq 100. Exiting 2023, we're a little bit expensive, but if you look out 1, 2, 3 years in terms of earnings, in terms of fundamentals, it's actually, again, not a very expensive story at all. So that's sort of where we stand with fundamentals. At the end of the day, though, right, what drives fundamentals? What drives outperformance? It's growth in the 21st century. And what drives growth? It's increasingly being recognized as being a function of innovation above all else. And, with that being said, I want to pass it over to my colleague, David, who's going to drill into that innovation story a little bit more and talk to you about how we quantify it, how we look at that innovation story a couple different ways.
All right, thanks, Mark. We'll now turn to have a look of the R&D comparison between Nasdaq 100 and S&P 500. Oh yeah, so that's the slide. As you can see that like R&D serves as a catalyst for innovation, and that enables companies to stay competitive in changing market dynamics. So from R&D spending perspective, it's not too surprising that you can see the weighted average annual expense is higher for NDX compared to SPX. But when we exclude those 80 plus Nasdaq 100 constituents that are present in SPX, you'll see the difference is actually huge. Like Nasdaq 100, they spend over 11 times as much in R&D as the remaining S&P 500 companies. And when we calculate the R&D as a percentage of sales in the last 12 months, the figure for index companies is nearly like 7 times as much as the remaining SPX firms. So such a big contrast highlights the significant investment in innovation in index companies. And in our next slide, we try to zoom in to the biggest R&D spenders in Nasdaq 100. So here we go to the next slide. We try to have a look at the 50 firms. That's the last slide, please. Yep. So it shows like the 50 firms that has the largest R&D spending in the index. You see from they have like 55% in index weight, and it allocate on an average 17% of their revenue to R&D. So like tech firms like Meta Platform and Intel, they reinvest almost like 30% of their revenue in R&D. And Microsoft also announced the plans to invest around $3.4 billion over the next 2 years in German AI infrastructure. So that'll be the firm's biggest direct investment into Germany. And moving on to the next slide, you can see that like mega tech firms, they have vastly outspent VC growth in investment in generative AI startup last year. So big tech firms, they need to make sure they are generative AI boats because there are just too many examples that incumbents that entirely missed the technology wave and they pay dearly for it. And we've seen market quickly consolidate around a handful of foundation models, with large tech firms they coming in and pouring billions of dollars into AI startups. This strategic investment enabled the big tech firms to monetize AI tools by adding more demand to their existing products. And Microsoft, Amazon, and Alphabet, they have been very active in backing AI startups, investing more than $80 million last year. And that represents like 2/3 of the global venture investment into generative AI startups. These deals include Microsoft's $10 billion investment in OpenAI, and also the billions of dollars raised by Anthropic from Alphabet and Amazon. And as you can see here, NVIDIA also backs up many of the AI startups that are important in this field. And going to the next slide, we'll have a look of the index companies that are involved in disruptive technologies.
Sorry, David, I was just on mute. I just want to make a comment there. I think that's really interesting. Like, if you look at companies that are able to spend 17% of their revenue on future growth, I mean, that talks to incredibly profitable businesses. There would be a lot of companies that don't have those sorts of gross margins to be able to do so. It's a clear advantage there. And that's quite interesting what you point out about these VC firms with leading models, effectively needing these large tech companies in order to sort of actually develop their product. There's quite a, there's significant synergies there, and the ability for big tech to really, I guess, take bets across that VC landscape. That's really strong.
Yeah, you're definitely right. We can see that big tech firms, they pull in billions of dollars to make sure that they're in this like generative AI game. And this will in turn like help them to sell their own existing products. So in the next slide, we try to see from a different lens, that is how those Nasdaq 100 companies, they invest in disruptive technologies. And here we go. In the next slide here. Yeah. So this slide, we try to show like how the investment companies in Nasdaq 100, they actually filed a lot of patents throughout last year. And as you can see that like 65 Nasdaq companies which represent about 83% of the index weight, they file patents across these 30 plus areas of disruptive technology. And disruptive technology, they will redefine the way how we live and work and fundamentally change the industry practice. And a significant portion of the patents filed by index firms were related to AI. So we try to shade these categories in purple. And areas like natural language processing, big data, and cloud computing. Like for instance, as you can see from the far left side, 40% of the NLP-related patents are actually filed by companies in the index in the last 12 months. And for these patents that indicate that the Nasdaq 100 components are indeed very well positioned to take advantage of the new wave of growth driven by AI. And now, as we spend some time talking about Nasdaq 100, we've been asked from time to time whether there's a way to capture the rising star list on Nasdaq with the potential to enter Nasdaq 100 in the future. So Mark will introduce the Nasdaq Next Generation 100 Index in this comment section.
Thank you so much, David. I really love that last slide that you showed. Just want to reemphasize the point for folks. We have this data set that our own Nasdaq AI team refreshes and compiles to drive some of our other thematic indexes that give you targeted exposure to things like AI or cybersecurity. So they screen patent filings and map them to about 20,000 publicly listed companies globally. So think about the fact that we're looking at patent filings over the last year across 20,000 companies, and just the 100 companies in the Nasdaq 100 give you 20, 30, in some cases 40% of the total patent activity for things like natural language processing, speech recognition, cloud computing, the key technologies that drive something like generative AI. That gives you a sense of how dominant these companies have gotten from all of those investments into R&D year in and year out to build up patent portfolios and get to this position where they're really able to capitalize on this growing trend. So that's the Nasdaq 100. As David alluded to, the Next Gen 100 is, we consider to be a second home for innovation. It's a natural complement and natural extension of the Nasdaq 100. It was an index that we launched during the COVID pandemic in 2020 and had an ETF launch in the US shortly thereafter, tracking it to really kind of capture the realization that a lot of the companies, especially during that time, companies like Zoom and Moderna, that were not necessarily starting out as among the biggest on the Nasdaq Stock Exchange, were sort of in that next tier after the 100 largest, often held a lot of promise. And so that's what this index is designed to do. The methodology is very straightforward. It's just the next 100 largest on the exchange, X financials. And so when you look at historically, if you were to model this index back, again, I mentioned this was launched in 2020. If you model it back to 2010, which is the earliest days of our back tests, and you say, okay, what would this index have looked like back then? Going all the way back to 2010, a total of 80 companies in this index, the Next Gen 100, graduated into the Nasdaq 100 and spent some time in this index to kind of give you the ability to track them in their earlier, faster growth stages before graduating up to the big, the big boy ranks of the Nasdaq 100. So that includes, well-known examples like Netflix in 2010, Tesla in 2013, DocuSign in 2020, AstraZeneca in 2022. And as of the end of the last year, 39 of the 100 companies in the Nasdaq 100 had graduated from the Nasdaq Next Gen 100 at some point over that past decade plus, based on those simulated backtests and live results. Here's the key thing to keep in mind with all of this. The mechanics of how this works is when companies are in the Next Gen 100, they are, if they're doing well, right, their performance is going up, their market caps are going up, they're getting closer and closer to that break-even point where they might qualify for the Nasdaq 100. Oftentimes when they get added to the Nasdaq 100, just like the S&P 500, they tend to take a breather in terms of performance. In fact, if you look at the median versus the average performance of an NGX company, in the 12 months leading up to graduation, it's around 70 to 80% price performance in the 12 months leading up to graduation. After they graduate to the Nasdaq 100, it's only about 10% in the 12 months after that. And when they graduate into the Nasdaq 100, they're coming in at very low weights, right? They're at the very bottom of the barrel in terms of size relative to companies like Microsoft and Apple. So you don't get meaningful exposure to them from a weightage basis when they get into the Nasdaq 100 and they start to trail off in performance. You get the meaningful exposure to them when they're in this index, when they're getting weighted at 2, 3, 4%, 4% being the cap on any company getting weighted in this index. And so the result is you get exposure to companies, like Alnylam Pharmaceuticals, which has been around for a little over 20 years, has a market cap of around 24 billion. It's not a tiny company. It's sort of like, a small large cap, actually. It's not even a true mid cap, because its performance recently has got it to that point where now it's at the top of the line. It's ready basically to graduate into the Nasdaq 100. And so this is a very typical example of a company where, unlike in the Nasdaq 100, where you've got some of these big diversified global tech conglomerates that have a bunch of different lines of business, diversified revenue bases, different areas of R&D and patent filings. A lot of the companies in this index tend to be more specialized. They tend to focus on maybe one or two areas. And so you end up getting a lot more exposure to things like pharma and biotech in this index, for example, versus the Nasdaq 100. In fact, if you break down the sector allocations versus the Nasdaq 100, you'll find a very similar new economy allocation. Those three sectors I talked about earlier, tech, consumer, and healthcare, about 80% of the index weight. But look at tech, only 32% versus 58% in the Nasdaq 100. A lot of that extra weight is being reallocated across consumer, across healthcare, a little bit across industrials and some other areas. But generally speaking, very similar story. Comparing to a broader US mid-cap benchmark, you're going to have no financials exposure ever, because that's in the methodology. You're going to be overweight new economy, and you're going to be underweight everything else. And so we picked, the S&P mid-cap 400 here and the Russell mid-cap to compare to. You'll see some more stats on how these mid-cap products in the US stack up, and I'm going to pass it back to David to get us into that innovation story and make some additional parallels to the bigger sister product here, the Nasdaq 100.
Yeah, thanks, Mark. And just as Nasdaq 100 has consistently scored better than SPX on various innovation metrics such as R&D spending, excuse me, you can see that the Next Gen 100 has benchmarks. And this chart shows that the R&D expense as a percentage of top line revenue. We plot this out every year going back to 2010. And you see that Next Gen, represented by the blue bars here, consistently spend like 3 to 4 times as much as the broadest mid-cap benchmark, the S&P mid-cap 400. But even versus the Russell mid-cap growth in purple, the NGX companies are consistently reinvesting 1.5 times and sometimes even 2 times more the ratio of their top line revenue back into R&D. And the following slides we also show on the left side, we try to compare the index in terms of the weighted average annual R&D spending. And you can see that for the Next Gen, the companies spend 90% more compared to Russell mid-cap growth, and nearly 2.5 times more than the Russell mid-cap in last year. And we also try to dig down to see the biggest R&D spenders in the Next Gen index. You will also notice the difference compared to Nasdaq 100 from a sector perspective, where Mark highlighted that the Next Gen has substantially less tech exposure than Nasdaq 100. For index, a lot of the firms spend much more in R&D. Let's say they're the biotech firms, followed by technology and also the consumer discretionary sectors. For the biopharmaceutical sector in the US, they spend around 21% of their revenue on R&D on average. And you see that some of the drug makers in NGX, they have a higher than average spending than that. Like for example, you can see Alnylam, they're in the middle of the chart. They're the leader in the RNA interference therapies and spent over like half of their revenue in R&D in the last 12 months. And next, we'll also have a look from a disruptive technology perspective. If we can see from the patent activity on the left-hand side, we also try to show the distribution of patent filings across 30 plus different areas of disruptive technology. Also, same as previously, the purple bars represent those sectors that are directly related to AI. And it's really impressive. You can see that categories like image recognition, deep learning. We've got like 20 to 25% of global patent filings in these disruptive tech areas that are coming from next gen 100 companies. And you can see that the index really punches above its weight, given that there are only 100 mid-cap companies out of the around 20,000 globally listed companies that we track. And NGX actually gives you around 50% or so exposure to some of these areas of innovation in AI. And on the right-hand side, you see that around 51 NGX companies with patent activities in the last 12 months. And on average, companies in the NGX, they file patents almost in 5 of themes. And this is much higher when we compare to only around 3 areas across each of the other 3 mid-cap benchmarks that we analyze. And you see that firms like eBay, Western Digital, and Baidu in NGX, they are very active in as many as 12 or more disruptive technology all at the same time. And of course, it's very important to compare the performance among different indexes as well. For the next 100 that is launched in August 2020, we have backtesting data back to the end of 2009. And compared to the S&P Mid-Cap 400, Next Gen 100 has delivered an impressive outperformance over such an extended time horizon of 435% on a price return basis in the last 14 years. So that versus only just 289% S&P index. And on an analyzed basis, that translates into more than 300 basis points of outperformance for the next gen each year. And at last, we also want to look at the position size of these indexes. And next gen, they utilize a modified market cap weighting scheme. So there's a constraint that no index security can have a weight that exceeds 4% during the rebalance. And it should come as no surprise that the top 10 constituents only account for 16% of the index at the end of last year. And by comparison, the top 10 holdings in Nasdaq 100 account for 45% of the index. And in addition, you'll notice that how the position sizing drastically different between the two indexes, with the top position in the Nasdaq 100 account for 9.2% of the index, while the largest position in the next gen is 2.1% at the year end. So overall, we see that the next gen index, they provide an instant diversification to existing investors that hold the Nasdaq 100 products. For next gen, they have a tighter range of constituent market cap that ensure less concentration at the top end of the spectrum, but as well, there's a more meaningful allocations to some of the fast-growing new additions to the index at the bottom end. And in the comment section, Mark will talk about the benefits of the equal weighting for Nasdaq 100.
Thanks so much, David. I think that's a perfect segue into the final topic, which is looking at the Nasdaq 100 equal weight. You know, when I look at that chart for the Next Gen 100, I almost think that it's sort of like a modified equal weighted index, given that the distribution of the weights is so tight. And I think that's one of the special things about mid cap in general, is that you don't have a big range in terms of the weights. It is a fairly compressed spectrum of market caps. So you really do get meaningful allocation to the companies all the way from 1 all the way down to the 100th position in the NGX. I think that's what makes it really special. And again, you know, as you mentioned, just a natural complement to the Nasdaq 100, given those same themes about outperforming on all the different innovation metrics whether it's R&D overall as a percent of sales, whether it's patent filings, whether it's patent valuation, which we didn't even have time to get into today, it all points in the same direction as what we've seen with the Nasdaq 100, just at a slightly kind of reduced intensity, obviously given the companies are much smaller. So now let's turn to the equal weight, and setting this conversation up, I want to point out that we have some products in the U.S. that track the Nasdaq 100 equal weight index. They've done really well over the past year. They've gotten about $1 billion of net inflow, which is pretty impressive when you consider the fact that the Nasdaq 100 kind of sucks up all the oxygen in the room most of the time. And that's a pretty historic inflow that we've seen into these products. And it's mainly a function of people over the course of 2023, I think to a large extent getting a little bit uncomfortable with how much concentration there was in the Nasdaq 100, both from a weightings basis and from a performance basis. That was a topic we encountered throughout 2023. In fact, though, when you look at the trend, when you look at the breakdown of the return contribution from the 10 largest companies in the Nasdaq 100 going back a decade, how much of the overall index return have the 10 largest names contributed over that time period? You'll see in this green line that we've been averaging 60 to 70% return contribution from those top 10 names, including a down year in 2022. We've been averaging 60 to 70% for a while now. So the breakdown, the return contribution last year was about 73% from those top 10 names, not actually that out of proportion to what we've seen historically. So it's something I wanted to just present visually and have people keep in the back of their minds when they're considering this kind of debate around, well, should I do equal weight? Should I do cap weighted? Are things getting too concentrated? I'm not sure. The beauty of it is that you can consider these products to be complements to each other. It doesn't have to be a choice of one or the other. You can use the Nasdaq 100 equal weight as a way to sort of balance out something like a sector concentration risk, which you may think 58% for tech is a little too high. Well, if you equal weight the Nasdaq 100, you only get 41% exposure to tech. You get a lot more in things like healthcare, in things like industrials, some of those other sectors that just don't have the same mega cap tech companies in them. That is instant sector diversification if you combine these two products together. In terms of company diversification and worrying too much about the exposure to the very top, yeah, if you look at the top 10 names in the Nasdaq 100, it's close to 50% of the index. Obviously, if you look at the equal weight, it's 1% per company, so it's only 10%. So if you do 50-50, you're all of a sudden kind of going to 30% of your overall allocation as to those top 10, the average of 10 and 50, right? So that's another reason to consider it. It's a great way to kind of balance out your individual company concentration. If you look at performance historically, and we've tracked this back a quarter of a century now to 1999, to really show you, I think, something interesting about how the performance works for this index versus the Nasdaq 100, which is that you can't really predict it very well. Last year was the worst year of underperformance on record since 1999, with the equal weight underperforming by 21%. That was after its best year of outperformance in 2022 in a down market, when it outperformed by about 8%. But generally speaking, over the past 7, 8, 9 years, we've been in a cluster of mostly underperformance of the equal weight because those big names have done so well and had so much fundamental growth to support the performance. There was a clustering of outperformance of equal weight at the beginning of the century, and then sort of in the middle, it was oscillating back and forth. So it's not that you can necessarily pick and choose and say, look, equal weight is due for many years of outperformance because it underperformed a lot in 2023. That's not necessarily how it works. I think it's more a question of how do you tactically want to think about using it together with the Nasdaq 100 to manage those exposures that you care about in terms of driving your overall risk levels, whether it is at that sector level or at the individual company level. And so I'll end on this equal weight note with going back to the conversation around performance. If you benchmark it against the S&P 500 equal weight, you see a very similar story to when we benchmark the Nasdaq 100 against the S&P 500 cap weighted. You don't get the same level of performance, especially because, again, last year, historic outperformance of cap weighted versus equal, but you still get 1.5 times the performance on a cumulative basis versus something like the S&P 500 equal weight. So again, we think a very attractive option for a benchmark to consider if you're looking at US, if you're thinking about equal weighting. There's a lot to like about this in that you still get all the meaningful exposure to innovation as a growth driver and to those fundamental growth vectors that outperform the broader market in the US. You just get it in a much more balanced package with the equal weighting. So that's sort of the story. That wraps it all up for us, I think. Cameron, let me pass it to you, and then maybe we'll head over to Q&A.
Great, thank you so much, Mark and David. I think there's some really interesting points there, and the bit that I find, really, I think, just useful to sort of understand is that expenditure in R&D, that long-term expenditure in R&D, and how that's translated through to compounding earnings growth. And it really is the explanatory factor in terms of why we've seen such strong performance. I show you here on screen just our suite of these Nasdaq indices. I'm sure many people will be aware of NDQ. It is one of our largest funds. We've had this fund in market for a long period of time. Interesting to note, in Australia, there are around about 1,000 equity funds, and that includes active, passive, it includes ETFs and unlisted funds in total. Of those 1,000 funds, if you look at the 5-year performance, NDQ is the best performing fund. And of course, I should mention that past performance is not a guide to future performance, but for anyone who's been invested in this fund, I hope that that's been quite a fruitful investment journey for you. So that's a really strong fund within our suite. We introduced JNDQ and QNDQ, and we can see the top 5 holdings there. Quite interesting to sort of look at the difference. For example, the equal weight has where we rebalance to 1%. In between rebalances, these stocks move around a little bit and we rebalance back down to 1%. So these all have a place in investment portfolios, and I think they offer like a range of alternatives which Australians haven't necessarily had available before. Of course, talking about that expenditure in R&D and where the story is. I mean, there's a lot of talk about markets, the Nasdaq, but also even the Australian market being at all-time highs. I think it's important when you're looking at markets not just to look at valuation ratios and where index levels are, but to understand the relationship between price and earnings, and in particular, the earnings growth over the long run. So a P ratio is really a ratio of price to next year's earnings. But if we think about how that's going to play out over time, when you own a company, you own all future earnings. So earnings growth is critical to thinking about valuations. And this is where these Nasdaq indices really stand out from other exposures. We see here the earnings growth, consensus earnings growth for next year for Australia and global versus the Nasdaq indices. The US is, if you like, an exception, but within the US it is the Nasdaq exposures which are driving overall earnings growth and revisions in the States. One other comment that we hear sometimes is that, at the moment, the US market is outperformed, and US equities make up about 61% of global market capitalization, but the US economy only makes up about 25% of global GDP. So does this need to correct? Is the Nasdaq a US-centric exposure? I think it's really helpful to actually look at the index in terms of where those underlying companies derive their revenue. And on the pie chart, the donut on the left-hand side there, I show the global, market cap weighted index, the MSCI World, and it shows that revenue breakdown there. So roughly half coming from the US and a good spread of revenue from other regions. You can see how similar the Nasdaq's revenue exposure is to companies, because these leaders in the US have become global leaders and they derive a lot of revenue across different parts of the world. And so you've got that global exposure in terms of revenue. But also, we're not just talking about US companies anymore. Mark mentioned, some, examples, and I've got some listed there. Atlassian, the homegrown IT hero of Australia, which decided not to go and list on the ASX boards, but chose really the prestige and the deep pools of capital in the Nasdaq as a better place to list. And that is what we're seeing, is that global leaders do have a preference for that more liquid capital market, and frankly, we're going to see more of that over time. Also, as an Australian investor, we're also thinking about the biases in our home market. We've got obviously this pie chart on the left-hand side shows the sector makeup of our largest 200 companies using the Sol Active Australia 200 index. We see the largest segment being financials and then materials. If you look at all three of those Nasdaq indices, they have very close to, or in fact zero, exposure to materials and financials. So on the right-hand side, we show the relative over and underweights of those Nasdaq indices versus the Australian equity market. So down the bottom, materials and financials, those Nasdaq indices would be considered underweight versus Australia versus obviously IT. In Australia, IT is about 2% of our index. We see that that's obviously a significant weight. So there's diversification benefits here. And just really quickly, I'll run through an example as to how someone might think about portfolio construction and incorporating a Nasdaq exposure. So what we show here is essentially the top two lines are showing the the return and the volatility of an Australian equity exposure and a global equity exposure. So in highlight there, I show the volatility, or if you like, the riskiness of those exposures. And clearly there's a benefit to using some global exposure within your portfolio purely on a volatility basis. This is showing these particular characteristics over a 5-year time frame. I compare that to the Nasdaq indices, and they are, as Mark mentioned, quite similar to the level of volatility of the S&P 500. They're not necessarily as low volatility as the broad global exposure like BGBL, but what they add really, I think, which is interesting, is when we look at the degree of diversification benefit from the fact that when we blend assets together, we ideally want them to move in opposite directions. The way we tend to measure that degree of relationship between asset prices is we look at correlation. So correlation can range between 1, when two assets move perfectly in line, to -1, when they move in the opposite directions. Now, typically for two equity exposures, you expect them to have a pretty positive correlation. So we see here between Australia and global, highlighted red, a correlation of about 0.71. So that's giving you some diversification from blending those assets. Indeed, if we look at the relationship between Australian equities and the Nasdaq, because of those different sector makeups, those correlations are indeed far lower. So that's interesting and beneficial from portfolio construction. And we show here the outcomes, and this is not a recommendation, it's just an example of how you might consider using a Nasdaq exposure, or indeed historically how that might have added to your overall portfolio outcomes. On the top line, we show the exposure if you held 100% Australian equities. The chart is shown in light grey there, its performance over the 5-year period. The global blend, so having half in Australian equities, half in a broad global exposure, increases the total return because global equities have done better than Australian equities, but it also reduces the volatility. So that's a good thing. However, if we blend in an exposure that includes 50% broad global and 20% NDQs index, we see the volatility, in fact, does not step up materially at all. However, the increased return over this time period is substantial, and that drives better risk-adjusted returns. So look, that's just a quick example. We will look to send through a Nasdaq paper that talks about blending Australian equities with Nasdaq exposures to those listeners after this presentation. But just talking about the use case and how these Nasdaq exposures can really work for Australian investors in terms of adding diversification. Just in summary, NDQ, way to get exposure to those globally leading innovators, the names, and obviously that sector benefit is clearly beneficial, really getting access to areas of the economy that are underrepresented in Australian markets. How do I participate in perhaps in the next generation of leaders, those Nasdaq companies between 101 and 200 before they enter the Nasdaq 100? JNDQ is really the complement there to the 100. If you want to hold companies for the entirety of that evolution. And QNDQ offers some really interesting sort of dynamics in terms of having that lower concentration and a different sector profile. So that's the formal part of the presentation, but we do want to turn to questions. And so I'll just make sure Mark and David, you've got your mics on. Maybe just to touch on one off the bat, and we have seen a lot of questions come in about maybe the potential upside or downside on particular stocks. We'll probably steer clear from that. Maybe if you just comment again on, is the Nasdaq in bubble territory? That was a common question that's come in.
Yeah, sure. I'll give you some historical context on that. At the end of the 20th century, at the end of 1999 going into 2000, PEs on the Nasdaq 100 peaked at around 250 to 300 on a trailing basis. 250 to 300. Those were the peak PEs in the dot-com bubble. We are nowhere near that. In late 2020, early 2021, we did approach 40 briefly on this index. Then we dropped down to about 20 after the drawdowns in 2022. And now we've sort of, again, bounced back because I think, number one, investors realize that, the drawdown in 2022, that multiple compression was really not driven by anything fundamental. It was driven by the rise of inflation, which has turned out to be, to a large extent, transitory in the US and in other areas, and the accompanying rise in interest rates. And people applied a higher discount rate to the same earnings and said, all of a sudden, this is worth 20 or 30% less than it was a year ago. I think people are realizing that that was a mistake, especially heading into 2023, where we had generative AI take off, obviously, with things like ChatGPT and Google's Gemini, and obviously NVIDIA's numbers, which have just been mind-boggling how much they've had to raise their guidance every single quarter to keep up with the pace of orders for their GPUs. I think people are realizing that this growth driver is real. It is not just something that's going to happen for a year or two. It's going to play out for 5 or 10 years maybe. And so when you're looking at 20% year-over-year earnings growth this year versus last year, and people were expecting, flat earnings going into 2023 and a kind of flattening out of the growth trajectory, you have to expect valuations are going to pick back up. And you have to really, again, look at what are the valuations today versus other periods in history where there was this type of growth driver and opportunity to propel that top line and bottom line growth over a number of years. That's how you got to put it into context. I would not say that we're in a bubble territory. NVIDIA is nowhere near a bubble.
Yeah, I think that's right. It's about the change in growth expectations for earnings. Another one, Meta's obviously, now like recently announced it's going to start paying dividends. Can you tell us about your outlook for whether you expect to see other tech giants follow? Are we going to see a greater level of dividend yield out of the Nasdaq in future? Any thoughts on that?
Yeah, I mean, I think it's an interesting question. I don't want to get too much into specific company forecasts, but I will tell you this: it's that we put out some other research on some products that track buybacks in particular. And we find that in certain years in the US, if you only allocate to dividend payers and you kind of forget what's happening on the buyback side of the capital return equation, you may be missing out as much as a quarter to 50% of the total return of capital to shareholders in the US. And companies like Apple and Microsoft and Meta and Amazon and Google, they've been buying back tens of billions of dollars in terms of their own shares for many years now, precisely for the flexibility that they can turn those programs on and off. They don't have to commit to dividends, for forever, and then have to potentially cut them if they realize, hey, we have some new area we want to invest a ton of R&D or a ton in CapEx to. That preserves the flexibility. So I would look at it from the perspective of, again, buybacks and dividends together as part of the shareholder return story. But when you look at someone like a Meta, the fact that they have such great earnings sustainability year in and year out, and they're throwing off a ton of free cash flow, yeah, it's not surprising that they announced they're going to be, they're going to be starting a dividend. I think the expectation is that Amazon is next in line because they really turned the dial on their profitability, on their earnings leverage recently. So I think you might see that from Amazon of the big names next, but not a forecast.
Yeah, okay, interesting.
Pay attention to both buybacks and dividends.
We'll look out for Amazon. So another, I think last question, we'll wrap up after this, but I thought I'd just ask you about Supermicro Computer. Like, this is a stock which is outside the 100 but has flown up, and I believe it's in the 200. I believe it's in the next gen. It's the largest weight in the next gen. Can you tell us a bit about this stock? This is one that's really sort of captured the imagination over the last sort of couple of months.
Yeah, David and I
sure.
have been going back and forth on this. So David, take it away.
Yeah, sure. Yeah. So for the probability of Supermicro entering index, I'll say it all depends on the market cap ranking when index is reconstituted this December. Because bear in mind that index is a modified market cap weight index. So currently for the market cap of Supermicro is around 60 billion. So relative for the ranking is around 60-ish among the non-financial companies listed on Nasdaq. So I would say if Supermicro, they keep the ranking in market capping around this range until December. So it'll be quite likely to enter Nasdaq 100 in the next reconstitution. But one more thing is that, do you remember that ARM, the chip maker, is actually ranked in a higher in market cap. And it just skipped over the next gen index just because of its timing of the IPO on Nasdaq. So in case there's deletion from the constituent in index before the December reconstitution, so maybe ARM would be more likely to enter the Nasdaq 100.
Okay, that's really interesting. Yeah, so to keep a lookout for ARM, recent IPO in the semiconductor industry. Great, thank you guys. I think we've gone a little bit over. I hope that everyone found that useful. We really appreciate you spending some time with us today. And I'd just like to say thank you so much to Mark and David. You really are knowledgeable in terms of your universe of Nasdaq companies, and I certainly get a lot out of our conversations. Thank you everyone on the line. We appreciate your support of Betashares, and we will see you next time.